Did you know that nearly 60% of Americans are overpaying on their taxes, simply because they don't know about the strategies that can reduce their liabilities? The good news is, you can take control of your financial future, and it starts with understanding the tax strategies that shape it. Today, we're diving into how you can build a tax-efficient strategy that works for you. Welcome to Factful Finance, where we break down the numbers behind your financial decisions so you can make smarter choices with your money. If you're new here, don't forget to hit the subscribe button so you never miss our latest insights. Now let's get to it. You might think taxes are just something you pay once a year. Send off that check and forget about it, right? But the truth is, your tax strategy can have a massive impact on your long-term financial health. Whether you're building wealth, planning for retirement, or simply optimizing your savings, taxes play a crucial role. So what are the key strategies that can shape your financial future? Let's break it down. First, let's talk about tax-deferred growth. This is a strategy where you invest your money into accounts like 401ks or IRAs, and you don't pay taxes on that income until you withdraw it. Think of it as putting your taxes on hold while your money grows. Here's an example. Mark, who started contributing $5,000 annually to his 401k at age 30, saw his money grow tax-deferred. By the time he was 60, he had accumulated over $350,000. Much of that growth was thanks to the tax deferral. Next, tax-efficient investment accounts are key. Did you know that the tax treatment of your investments matters a lot? Long-term capital gains, for instance, are taxed at a lower rate than short-term gains. So, holding your investments for more than a year could help you keep more of your returns. Let's say Sarah invests in stocks and holds them for a year. When she sells, she gets taxed at a long-term capital gains rate of around 15%. However, if she sold sooner, the tax rate could be much higher, up to 37% for short-term gains. A huge difference. Then there's tax loss harvesting, a strategy that's particularly useful in volatile markets. This involves selling investments at a loss to offset taxable gains from other investments. For example, John has some stocks that aren't performing well and he decides to sell them at a loss. By doing so, he can reduce his taxable income for the year, saving him hundreds or even thousands in taxes. It's a strategy that's often underused, but it can make a significant difference. Another crucial strategy is contributing to tax-advantaged accounts, like health savings accounts, HSAs, or 529 college savings plans. HSAs are incredible for their triple tax benefits. Your contributions are tax-deductible, the money grows tax-free, and withdrawals for qualifying medical expenses are tax-free. If you qualify for one, consider maxing it out. For example, let's say Jake has an HSA. He contributes $3,000 this year, and next year his account grows by $500. The $500 is tax-free as long as he uses it for medical expenses. Over time, that can add up to significant savings. Now, here's something that may surprise you. Bunching deductions. This strategy involves combining 2 years' worth of deductions into 1 year to maximize your tax benefits. For example, Emily, who usually donates $5,000 a year to charity, could bunch her donations and give $10,000 in 1 year. By doing so, she could increase her itemized deductions and potentially qualify for a larger tax benefit than if she spread those donations out over 2 years. Of course, these are just a few strategies, and the best approach will depend on your specific situation. But what's important to remember is that taxes aren't just something that happen to you. They're something you can plan for and optimize. Now, before we wrap up, a quick disclaimer. This video is for educational purposes only. For personalized advice, consult a tax professional or financial advisor who can guide you based on your unique circumstances. So how can you implement these strategies today? Start by reviewing your retirement accounts. Could you be contributing more? If you have investments, consider the tax implications of when you buy and sell. And if you haven't yet, think about tax-advantaged accounts like HSAs or 529s. What's the first step you'll take toward optimizing your tax strategy? Let us know in the comments. And if you liked today's video, why not give it a thumbs up? We think you'll find our next video on investment strategies just as helpful for your financial goals. Thanks for watching, and we'll see you in the next one.